Hi everyone, I'm going to talk briefly about potential impact points from the Ukraine conflict, the Russia-Ukraine conflict, the invasion that started on the 24th of February and which potentially gets quite disruptive for the world economy in certain ways. And if it does for the world economy, that has implications for the South African economy, but I'm going to talk about how it filters through then potentially to the South African property market. I think that firstly, it's important to emphasize that I think it's impossible to quantify anything, to see how this plays out. It's not predictable at the moment as to where this conflict ends and to how far measures such as sanctions and boycotts from much of the world on Russia go and what impact they have economically and possible retaliatory measures as well. I don't think that's in any sense predictable. But there are potential risks, there are potential key macroeconomic risks that have reared their head already. Two of them, I think the two big ones, is obviously an additional inflationary risk. Global inflation has already become problematic due to supply side disruptions, so supply chain disruptions from COVID-19, lockdowns all over the world. That's well documented, and global inflation has become troublesome too, to the extent that many banks are either hiking interest rates or threatening to start hiking interest rates fairly soon. And that's regardless of the Ukraine conflict, so that's where we are. The global economic growth rate has recovered, but this year, in many instances, projected to start slowing after a big spike off the 2020 low base after that big recession that happened during the hard lockdowns of the world. So that's where we are economically, and the potential is for, I think, for the Ukraine conflict to add something to global inflationary pressures that are already there and to take away something from economic growth compared to what would have otherwise been the case. Those are the two big deals. Now, I think the obvious concern economically for many of us economists is watching oil prices go to Brent crude just today, topping $115 odd a barrel, thereabouts. That's about 17% up from where it was prior to the invasion. So that makes a meaningful difference to already troublesome energy prices. There have been big rises before that, and locally in South Africa, petrol price inflation has become a key driver of overall CPI inflation and its acceleration. So that's the big obvious potential impact is energy prices. Russia is a big oil and gas producer, and any disruptions to Russia via boycotts and sanctions threatens to disrupt supply to the world, and so the markets have become jittery about that. Some of our agricultural economists, though, also point to food price inflation, Ukraine being a big agricultural producer and that being disrupted or potentially disrupted by the conflict. So it's possible that we could have a global food price inflation surge, and with a lot of our agricultural prices domestically linked to global prices, that could mean additional food price inflation in South Africa. Bad from a consumer inflation point of view, but there is an upside to that, and that's good for, obviously, for the sales of agricultural producers during that time. So it is conceivable that while there's an additional inflationary impact via food prices and oil prices, notably, those are the ones that are talked about, and if there's rand weakening due to risk-off type of behavior from investors, then a rand inflationary effect, imported inflationary effect as well. But besides the additional inflationary impact from the war, there is the possibility that price inflation in foodstuffs and even gold commodity price inflation could positively affect some producers here. Gold producers, potentially. Gold is a safe haven asset, so it could do quite well during this conflict, depending on how bad the conflict gets. And then food price inflation for the farmers, obviously, that could be boost their sales temporarily. So it does have some positive economic impacts, but we believe that the overall economic growth impact will likely be negative. Against the possible some subsectors of mining and agriculture benefiting with higher prices for their sales. The overall global economic impact, I believe, will be a dampening one. Oil price shocks, if they're big enough, often send the world even into a recession. So A lot depends on oil and broader energy prices and how badly they get pushed up, if at all, from here onwards by this conflict. So dampening global economy, that filters through via broader mining exports, which weaken in such times from South Africa. Demand for our manufacturing exports, manufacturing being a very big sector. So overall, I would think that it would be a negative economic impact for South Africa, despite those few subsectors being positive. Negative economic growth, increased additional inflationary pressure to where we are, possibly then additional interest rate upward pressure compared to where we would have been without it. Interest rates are already rising, but could they rise possibly slightly more as a result of higher inflation as a result of this Ukraine conflict? That's the risk. Too early to tell. Depends on how long this all lasts, but that's the potential risk. And higher inflation risk and higher interest rate risk, and then of course weaker economy risk, which can filter through into weakening government finance, government revenues, tax revenues locally, all seem to push up long bond yields too, which are noticeably up since the start of before the start of the conflict. So long bond yields up as well, upward pressure on them emanating from this conflict in the early days. So I think that if you've got upside risk to short and long-term interest rates as a result of this conflict, I'd say that's an upside risk to capitalization rates on property. And that if anything, the war would push cap rates up further. Cap rates on all three property classes, the main ones, industrial, office and retail, have already been broadly rising for a number of years now, as government finance deteriorates, for one. So that's just added impetus to that broad upward trend, I believe. Okay, so that's capitalization rates. Additional upward pressure on capitalization rates would mean some additional downward pressure on property valuations. Then there's the vacancy rates. Now, recently in our F&B property broker surveys, we've seen brokers point to declining industrial vacancy rates and possible stabilization in retail and office vacancy rates after a multi-year rising trend. That's useful. But if the conflict dampens the economy from here onwards, I think that could possibly lead to renewed rise in at least retail and office vacancy rates and further downward pressure on their rentals. Industrial might survive if it doesn't get too bad. Industrial's got a lot going for it in terms of the gearing up for greater logistical requirements and warehousing requirements because of greater online retail. That's a key driver of a key structural change for industrial property, but the other two are fragile, and their rising vacancy trends could be renewed if the impact is too severe. So then there's operating costs. Can this war impact and its inflationary impact get through to operating costs? I think so, indirectly. Service providers who provide various operations related services to landlords, the general inflationary impact of them can mean higher than otherwise price hikes, charges. But then there's the utilities, the big utilities, Eskom. They can conceivably try to claw back lost revenues in a recessionary or weaker economic environment, and doing this by increasing levies more than would otherwise be the case. And I suspect municipalities could do that too, should their rates bill come under pressure, or their rate payers come under pressure, and payment performance deteriorates in any sort of way. So there's upside risk to operating costs too from an additional inflationary impact and a weak economic impact. Valuations then, how do they fare? Well, again, it all depends on where this conflict ends. But I think extra downside risk for property valuations. We've just been getting to a stage where I think that at least industrial and possibly retail, we're going to see capital values grow positively this year. I'm not sure office was there yet, possibly still in decline. Office has got big challenges and very high national vacancy rate. but the other two possibly. Any significant economic impact from this war could conceivably at least send retail values back into negative territory. Industrial's in the strongest space, but it's important to understand that none of the three property sectors are spared from the global risks. If you look at the economy that's related to these sectors, manufacturing links strongly to industrial property. And manufacturing is a big export sector that can be affected by a global slowdown. So there's a link to industrial. Retail, a more indirect link. Higher consumer inflation eats more into disposable income, less real purchasing power, and rising interest rates eats into cost of servicing debt, and therefore into cost of available income for consumption in retail malls. So the consumer can be affected that way. And then, of course, the consumer can be affected by weaker than otherwise job creation in a weaker than otherwise economy. And office, the same. The office sector is not so directly linked to the external economy, but it filters through into the services sectors with a lag. And sectors that depend on office space, weaker economy, weaker job creation, weaker than otherwise would be the case, demand for office space. So they all get impacted in some way. I don't think there's any way out should there be a noticeable economic impact from the Ukraine-Russia conflict. But as I say, that remains to be seen. The final sector I just want to mention is the residential rental sector. I think that one really hangs in the balance. I've expected some sort of improvement or strengthening in the residential rental sector. The tenant population has improved its payment performance noticeably after the hard lockdown knock that it received, but it's still a fragile tenant population. Rental inflation had just gradually started to turn the corner as vacancy rates started to come off extreme highs early last year. So things have been looking better for the residential rental market, and I think with mild interest rate hiking, that could persuade many aspirant first-time buyers to postpone their buying decision, hang out in the rental market for longer, and provide some additional support to the rental market. So mild recovery in the rental market, I think, was on the cards. That can still carry on if the war impact is mild. But if it gets too severe quickly, I think that can turn to renewed deterioration, because the tenant population in this residential rental market, I think, is financially still fragile after a big recessionary knock of 2020. So that's it in a nutshell. In short, there is a potential impact via capitalization rates, via the inflationary and interest rates upward pressures that this conflict can bring, energy prices being a key concern, food prices being another concern, via negative economic impact and the effect on demand for commercial property and thus possibly on vacancy rates and rentals. It can even get through to operating cost inflation too. So there's an additional, largely negative impact, dampening impact on the commercial property sector, potentially. I say potentially because I think it's a real wild card, this conflict. We've got to try and identify the risks, but it's really unpredictable at the moment as to how far the conflict goes itself and all the global responses, which can be highly disruptive to the supply side of the world economy, to various supply chains, can be highly disruptive. Will they be? I think that depends. That we need to wait and see.